Okay. Good evening, class. Sorry about a little delay. Sorry, give me a time, please. Let me just. Oh. Okay. So thank you. Good evening once more. Today we shall continue from where we stopped, which is a build-up of where we stopped on journal last class. So before we go about that, I just want to probably explain or determine some issues that we actually talked about last time. We said that the what we're doing is we'll be doing what we call the report of the financial statement. That what we'll be doing in class today, majorly it will be adjustment of financial statement or adjustment of final accounts. Like I said, if you notice me, I do repeat the list. If you notice me, I do repeat the account process all over and over again because it's the process that we are trying to work to expatiate so that you can aid more understanding. So I talk about that we're collecting of data. So we have done that. We have seen the difference between the event and financial transaction. We talked about journal. We have raised journal. We talk about ledger. We have posted into ledger. Now we talk about trial balance. We have raised trial balance. Now we know that trial balance have what? Have the debit side, the credit side, and the particulars. So we have done that. Then the next thing that we talk about also is adjustment on trial balance. It means that we need to adjust our trial balance. The reason why we are adjusting our trial balance is that there are some transactions that normally come up at the end of the month or at the end of the year that we need to now effect on our financial position. So those are the things, the reason why we normally have what we call the trial balance and adjusted trial balance. Now, example of this, that's what we'll be doing today. So example of that is actually what we know as the okay, now we have adjustment to trial balance. Now the major adjustments on final account is actually number one, we have the depreciation. Number two, we have the bad debt and provision for bad debt. Number three, we have the accruals and prepayment. Major adjustment that is being done either at the end of the month or at the end of the year. And I will explain further the reason why we have an adjustment, because as we carry out our normal activities, we have debit, cash goes in, cash go out. Whenever there's no cash goes in, we'll put it in this way. And because of accrual basis that any expenses that we incur should be matched against with our revenue. That also let us to what to able to if you pay money in advance, for example, if you pay money in advance and you have that as a current asset. So you have like maybe 20,000 naira in your current asset. At the end of the month, you have to take the apportionment, the part of what you have consumed for that month, so that you can take it to your profit or loss statement. So that's adjustment. It's just to give insight. Now, for us to go into it, we are going to start with depreciation. Now, for us to understand depreciation, we need to talk about the IAS 16. IAS 16 is all about the property, plant, and equipment. Property, plant, and equipment. At your level, you'll be dealing with, I think, 5 or 6 standards at your level right now. And please, you need to know this standard. The first one is IAS 1. That's what International Accounting Standard. IAS 1 means preparation of financial statements. And we have talked a little bit about that in our first class. That talked about the enhancement, the quality of data that must be there, the measurement criteria, the also with what we call the recognition, and the rest. These are the examples of what is entails in IAS 1. Another one that we have is IAS 2, which is inventory. We're going to talk about that as well. Another one that we have is IAS 7, which is what statement of cash flow. how we prepare our cash flow statement is actually very, very important as well. Another one that you have at this level is IAS 8. IAS 8 is change in accounting policy, estimate, and correction of errors. Then that's the new standard that has been added. In the old syllabus, you don't have IAS 8, but now it has been added to your syllabus. So it's a standard that you watch out for. Then another one that we have there is what we call the IAS 16, which is property, plant, and equipment. IAS 16, there is 90% chances that they will test IAS 16. You can't escape from IAS 16. I'm saying 95% chances for them to test IAS 16. And the reason why I say so is because if you look at your syllabus, IAS 16 alone is 20%. And 20% means that's 20 marks of your what? Of your exam. So it's a standard that you must not joke with. You must know it into two. And IAS 16 is like the adjustment towards the financial statement. That's what I'm going to try to talk about today. And I'm going to tell you one or two things that you expect to know. You're not expected to know everything about IAS 16, but the part that you expect to know, I will explain. The part that you're not expected to, I will mention it, so that in case anybody is telling you, you will also know that yes, it's actually in IAS 16, but it's not testable in your examination. But it's very good for you to know it. Now, non-current assets and depreciation. What understand by non-current assets and depreciation? Now, non-current assets, as we have earlier said when we started the class, that's last week, that our non-current assets are actually divided into two parts, which is the non-current asset and the current asset. And we said the non-current asset are assets that are useful for more than 1 year. They are often referred to as well long life assets. That these are the assets that whenever they are assets that you regard to as long life assets that are used more than 1 year. That's a non-current asset. And when we're talking about non-current assets, we are talking about the examples, what we have earlier said about the land, the building, the equipment, the motor vehicles. These are the, and they are majorly classified as what we call the PPE, which is property, plant, and equipment. And that's why IAS 16 is a standard that addresses PPE. What the standard is trying to address is, number one, how do we recognize it? How do we recognize cost of PPE in our financial statement? That's what we call the initial measurement. If you remember as well, I'm taking it back also to the first class, I think the second class, that talk about the measurement, that we have 3 types of measurement in financial statement. We have the initial measurement, we have the subsequent measurement, and we have the recognized measurement. That's when we are taking the amount away from your book. That's the 3 types of measurement that we have. Now, the same thing here also, this standard is trying as much as possible to measure that. Now, another thing that you need to know of, apart from the measurement, is to know the value. Because whenever anything based on monetary concept, if money or value is not attached to it, then it can't come into our financial statement. So another thing that we need to know also is that we need to know the cost of the assets, so that we can add it into our financial statement. Whenever there is no cost on the assets, then we must always find the cost, or it will not be posted into our financial statement. Now let's talk about initial measurement. Initial measurement is talking about the cost that will be recorded in the financial statement when it is purchased. It means that if you go to an asset, to a market right now, and we purchase an asset, that asset that we have purchased, what will be the cost? That's the initial cost. The first time that it will appear in our financial statement, what will it be? That's the initial measurement. Now, initial measurement when you talk about PPE, is actually straightforward. It means that every cost that you incur to bring the asset to the point that will be readily available for use will be added together and sum to give us the total cost of the assets. What I explain right now is that if you go to the market right now and you purchase, maybe let's say you go to the market, you purchase a motor vehicle. Now, if you purchase the motor vehicle, that's of the cost of the motor vehicle is not the cost that you will put in your financial statement as the cost. What you are going to do is that you need to, number one, calculate all other costs that make you derive the cost, that derive the motor vehicle, and make it available at the point of use. So if I go to the market to buy a motor vehicle, let's say I purchase the motor vehicle for 1 million naira. Okay, fine. Now, for maybe when I went there with an expert, a professional. So the professional check it out, and the professional charged me, let's say, 200,000. Now that 200,000 is the cost that I've incurred because I want to purchase the motor vehicle. So I have 1,200,000. Now after that again, I actually in cost of bringing the vehicle down to the place I need it, I hire a driver to bring it down. So I pay the driver, let's say 50,000 naira to bring it down. At the same time, also, I incur some costs on papers, documentations, just to make sure that maybe documentations, all the rest. I incur, let's say 500,000. Now I've incurred 1 million naira for the cost. I've incurred 200,000 for the professional advice. I've incurred 50,000 for the driver that brought down, and I've incurred 200,000 for the documentation. Now, all these costs added together will now be the total cost that I will post in my financial statement. And the total cost will now be 1 million plus 500,000, plus 500,000 plus 1.5 plus 50,000 give us 1,500,000, 550,000. And after that, we have plus 200,000, that's 1.75. That means that the total cost that I use to purchase the motor vehicle is 1,750,000. That is the amount that it will show under my PPE motor vehicle account. It's not 1 million. It's the addition of all relevant costs. Now, if you look at this, now that's IAS 16 says that the cost of an item of PPE consists of, can you see it here? I'm writing it so for us to see. So we have is purchase price after any trade discount are being deducted. If you remember, if you try back to our initial class, I said that we have two types of discount, that we have cash discount and trade discount. And I said cash discount as this is the discount that is given to encourage early payment. And it has two types, disallowed and discount allowed and discount received. But trade discount, this is a discount that are being enjoyed or received at the point of sales. It's a discount that enjoyed or received at the point of sales. It allows us to buy in bulk. It encourages us to buy in bulk. And it is not, it's stated on the receipt. It's stated on the receipt. For example, I want to buy a product. They say product is 20,000 naira. Okay, if I buy 5, they will reduce 10,000 naira for me, which I'm going to pay 90,000 naira. Now, if you look at it on the product, they will write 100,000 naira. Fine, but they will not say discount of 10,000. Then they will write 90,000 naira payment. It's not 90,000 naira that you are going to take and recognize as cost. That's what that line is referring to. It's purchase price or list price, which is 100,000. Minus the trade discounts on the documents. You are not paying cash, it will be on the document. Minus the trade discount, which is 10,000. They will not give us the total cost of the equipment, which will not be 90,000. Then after that, we now plus any import duties on non-refundable sales tax. We add that to it as well. Also plus the direct attributable cost of bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. Now, this goes a lot further again. For example, if you purchase a plant that you want to use it to produce in manufacturing setting. Now, if the cost that you're going to use to purchase the plant. Number 2, the cost that you're professional. Number 3, assembly the cost that you use to assemble it. Number 4, the cost of material that you use to test on the machine before if you buy a machine now, you have to test on it. And those costs, those that you put in the machine to test on it will be added to it to give you your total cost. That's what IAS 16 is talking about. That's what IAS 16 is saying. Now, you now say that what this direct attributable cost include, they give us an example, employee costs arising directly from what installation or construction of assets. We have the cost of site preparation. We are preparing the site. We have delivery costs. We have the installation and assembly costs. We have testing costs. We have professional fee. But they're like I've explained earlier, these are the all costs will be added together. A company has now, so there's an example there for us to test ourselves. So let's test that. A company has purchased a large item of plants. The following costs we are incurred. So we have number one, we have list price of the machine. The list price of the machine is the price that is being displayed. It's not the actual price that we acquire the machine. Is the price that is be displayed. That's what I say list price. Trade discount given to company. Remember that we need to remove our trade discount from our listed price. We need to remove our trade discount from our listed price to get the actual amount of the machine or of the equipment or of the asset purchased. That will now be 1 million minus 50,000, and that will give the actual cost will now be 950,000 naira. Then delivery cost. The cost of bringing the machine down to the place where it's being needed. And that one, installation cost is valid as well. If installation cost is valid, it must be added because it's part of the cost. Because without installation, the asset will not be ready for use. So it's part of it. We have cost of site preparation also to prepare to make preparation for the machine to be brought on board. And that one also, we have the architect fees as well. We have the administrative expenses. Now, the administrative expenses is not a valid amount to be added to the total cost to derive our cost of plant. The reason why the administrative is the admin expenses is not liable or valid is because either we purchase the machine or not, we are going to incur the admin expenses. So it's not expected to be added. And admin expenses is the revenue expenses, not capital expenses. So it cannot be added to the cost of the plant. So these are the so look at the solution. Machine cost we have to be 950. After 1 million minus 50,000. Delivery cost we have to be 100,000. Installation cost we have to be 125,000. Cost of site preparation to do 200,000. Architect fees to do 15,000. The addition of everything to give us together to do 1,390,000. This is the total cost of the asset that will be displayed or that will be posted to our asset account. So the accounting treatment is this. If you remember the rule of debit and credit, that is the entry rule that I explained earlier, that whenever an asset is being increased, you debit the asset. And whenever the asset decreases, you credit the asset account. Now, this is a purchase. It means that our plant account is increasing. And whenever our plant account is increasing, it means that we are going to debit the asset. That's why we have the accounting treatment to do debit the plant account. Now, which account is given? Is it the bank that is paying for the asset? If the bank is paying for the asset, it means that bank is giving. Bank is an example of current asset, and it also follows the same thing. It means it's reducing, and whenever it's reducing, you credit the asset or payable. When talking about payable, so either you pay cash. You can acquire an asset either in on credit or cash. So if it's on cash, you credit your bank account. But if it's on credit, you credit other payables account. Now, other payable account is a liability. And the rule says that whenever there's an increase in liability, you credit the liability account. That's the rule. So what the amount that we are going to use to debit and credit this account is 1,390,000 being cost of plant purchase. That is the initial measurement. That is the initial measurement. Now, we now have, after that, there are some things that we now need to work. So excuse me, there are some things that we now need to work to clarify. We have what we call capital expenditure and revenue expenditure. We have capital expenditure and revenue expenditure. Now, capital expenditure, in a sense, is actually an amount that we incur on non-current assets to increase the performance of the non-current assets. Now, if we now find out that this capital expenditure is actually the expenditure is capital in nature, then we capitalize it. It means that we are going to take that capital amount, we are going to take that expenditure amount into our capital, so into our non-current asset account. I'll repeat that. Whenever you have a capital expenditure item, that figure will be taken to our non-current asset account because it is improving and increasing the non-current asset. For example, an asset is expected to last for like 2 years, for 5 years. Then after 2 years, you carry out a maintenance, a major maintenance on it. And that maintenance now increase the span. It's expected to last for 5 years. Now, it have used 2 years, so it's expected to last for the remaining 3 years. And after you have done your maintenance, you will now notice that 3 years is too short. That is going to last for maybe in the next 5 years. It means that that amount of money that you have spent on that motor vehicle will be capitalized. In practical sense, when you are using a vehicle and you now notice that this vehicle is giving an issue, then you now bought an half engine. You bought an half engine. When you bought an half engine, it means that that lifespan of the vehicle has increased. That amount of money will be capitalized. Or maybe the asset is giving you 10,000 units on a monthly basis. You now carry out you incur an expenditure on the asset. That production now increased from 20,000 to 30,000. That amount you have incurred is what you need to capitalize. That's an example of what capital expenditure. Then another one that we know is the revenue expenditure. And revenue expenditure are the repairs, the cost of repairs that are being done on the non-current asset. Now, the non-current, the revenue expenditures are to be expensed, which means that they are taken to the profit loss account. They are not expected to be taken to the non-current asset account, but they are expected to be taken to the what? To the non-current. So they are expected to take to the profit or loss account. Now, example, motor vehicle. You now notice that you are buying fuel. Purchase of fuel, plugs, changing of some things, maybe changing of tires and the rest. These are not expected to be they are not expected to be capitalized, they are expected to be expensed, but subject to the policy of the company. Because there are some people that expense motor vehicle. So it's subject to the policy of the motor vehicle. Subject to the policy of the company, the management, what the management are seen fit for their own operation. So please, you need to know that what to capitalize and what to spend. Now, we have done the initial measurement. We have recognized our transaction. We have recognized that, okay, this transaction is what give us this particular amount, and we have debited our assets. But over time, during the period, maybe during the year, you started using the asset. You started deriving economical benefit from the asset. That economical benefit from the asset is expected to be charged against the profit, going by the rule of matching concepts. If I purchase I purchase an asset now, motor vehicle. Motor vehicle will last me for 5 years. I've entered it into my non-current asset as okay, 1 million. Is there on my asset 1 million. I purchased it in December, ending. So in January, I use it. At the end of January, I'm expected to account for the value of the what of the economic benefit I've enjoyed from that motor vehicle. I'm expected to account it and take it to my profit or loss account. That is what we call the what subsequent measurement, and that is what brings in what we call depreciation. That's why depreciation can be defined as a gradual fall in value of a non-current asset arising from wear and tear, obsolescence, and passage of time. But according to IAS 16, IAS 16 define depreciation as what? Thematic allocation of the depreciable amount of an item of property, plant, and equipment over its estimated useful life. Systematic allocation. I purchased an asset that will last me for more than 1 year. Now it means that after a month or a year, I'm expected to account for the value of what I've enjoyed from that asset. That amount or that value that I've enjoyed from the asset is being regarded to what as depreciation, and that's why it's regarded to what systematic way of allocating the depreciable amount, which is what on non-current asset, following the law of what matching concept. Now there are some terminologies that we are what called depreciable assets. These are assets that have the following features. Depreciable assets. They have the following features. Useful life is more than 1 year. Number 2 is acquired for what? For use in production of goods and services. It's not acquired for immediate consumption. It's acquired for use to produce another to render service, to produce another what? Another resources. And that one also is what? It has a limited useful life. It's not just long time like that. It has what? Limited useful life. Though you might actually be aware that some people say that what land is actually what depreciable. It's not expected to be what to be depreciated. Last land because what is being is it appreciates. Because you purchase land now over time, it appreciates. But there's another school of thought that say land is expected to what? To be depreciated. And the reason why land is expected to be depreciated, according to the school of thought, is because the law says that after 99 years of use of land, the land will return back to the government. But that's that by the way. I'm just telling you. So majorly, generally speaking, many accountants have believed that land is not expected to what to be depreciated, but to what to be it appreciate. It means that its value increases over time. It does not decrease over time. Okay, so that we now have another features also is what not intended for sales. We purchase an asset not to be what not to be sold to get a profit, but you purchase it because you want to use it to run your business. Another definition of terminology that you need to know, please, you need to know all this as we go further into the study, is what the residual value. Residual value, this is also known as what your cost scrap value. It is the estimated amount recoverable from the disposal of a non-current asset after its expected useful economic life. It means that this is the amount you derive, that you collect based on when you dispose, when you let go of your non-current assets. Which means if you have a vehicle and you sold the vehicle, the amount that you sold is what we call the amount that you think that you can sell it, is what we call the residual value, that is the scrap value. And that one we do what? Obsolescence. This is actually what is a factor which renders the non-asset useless due to what? Due to it's actually good though, But do what? Even though it's in good condition, but what? Because of technology, it can be because of technology aspect, it can be because of changing taste. It's render it useless. For example, now when we have before we have a lot of we have okay, for example, we have of when GSM came out, we have a lot of big GSMs and phone, very big. But now people are no longer using it. They have actually moved away from it because what? It's obsolete. Because it can't give them, it can't give people what they actually derive, what they intend to derive from it. So they are moving from away from it. That means that what that asset, that phones are what is obsolete. It's not because it's not in good condition. It's not because you can't call or send out a message, but because technology have advanced more than a state. Then we now have method of calculating what depreciation. We have a lot of methods for calculating depreciation. But for the purpose of this class, we're going to mention just three. And I will mention some of them as well. That is not what that you can know. You can just make more research on it. Now, the method is number one, we have the what called the straight line. Number two, we have the reducing. And number three, we have the revaluation method. These are the what? These are the common method that we use in practice. But there are other methods also that can be used in practice. Now, the first one I will call the other method, some of the other methods are some of the year digits or production, depreciation, and the rest. So, example we call straight line method. Straight line method, under this method, the cost is what? We use the scrap value to reduce the cost, then divided by the useful life, the economy useful life. It means that when you purchase an item of 20,000 naira and you expect to sell it after 5 years or for 5,000 naira, and that's what that would now be 20,000 naira minus 5,000 naira, give us 15,000 divided by 5. That what? That would give us 15,000, that's 3,000. And it means that you on a yearly basis for the next 5 years, you are going to be enjoying a economical benefit of 3,000 from that asset. That's what it means. So you are going to what? Expense that 3,000 over time. So we have the formula here that talks about the what? The annual depreciation. So we have cost minus scrap value divided by what? Useful life in years. In years, not in months, please. If you want to get it in months, then after you have gotten your result, you divide it by 12 to give you a month. Now, example one. A machine costs 100,000 naira. It has an estimated useful life of 5 years. A salvage value also is the same thing as scrap value. It's also the same thing as what? Residual value. So please, if you see scrap value, residual value, or salvage value, they are all the same. It means that the amount that you can derive from the disposal of the assets. So they are the same. So we have, okay, at the end of the 5th year, which means what? Which means the asset is expected to what? Have useful life of 5 years, 5 years span. Okay? And that would be what? 10,000 naira. What is the annual depreciation? Now the annual depreciation will now be the cost, which is 100,000. The cost, which is 100,000, minus the what? The scrap value, the salvage value, the residual value, which is 10,000, divided by the useful life, estimated useful life, because you estimate it. That's when I mentioned in the beginning of the class, IAS 8, that talk about what? Changes in accounting policy and estimate. That's what it allows, the standard allows accountant to make what? To make professional judgment on the useful life of an asset, and based on what? Based on the findings in the market. So we have that. So they expect to work the target for this asset is expected to last for 5 years. So 100,000 minus 10,000 divided by 5 will give us 18,000. It means that on a yearly basis, we'll be enjoying a total value of what? 18,000 from the asset, from the machine. 18,000. That 18,000 will now be used to reduce the cost of the asset. Then we will charge us on our profit or loss. We're going to see the double entry as we go further in in the topic. So we have another method that we have is what? Reducing balance. Reducing balance. Reducing balance makes use of a percentage to reduce the amount that has been carried in a book. Now, reducing balance, it means that whenever a percentage is given to us, 20%, for example, if 20% is given to us and a purchase item of 100,000, Now that's 100,000. That'll be 20% of what on the 100,000. I'll calculate that. Let's look at the example to explain that better. So we have number one, example two. A machine costs 100,000 is to be depreciated at 20%. That's 5 years also. 20% in 5 years. 20%. What will be the depreciation expense at the end of the third year using reducing balance method? So we expect what to know, okay, what will be the depreciation at the end of third year. So, and the formula is what? The formula is 20% times the carrying amount or times the book value or times net book value. Okay, the formula is what? 20%, which is a percentage given to us, depreciation percentage times the carrying amount, or the carrying amount also is what you know as what? Book value. And how do you get our carrying amount? Our carrying amount is actually what? The cost minus accumulated depreciation will give us our carrying amount. It means that what? This is the value of the asset that we have recognized in our book, that we think that if we dispose it at the particular point of time, this is the amount that we can derive from it. That's why we call it carrying amount, the amount that we carry our asset in our book. Accumulated depreciation, it means that what? The addition of depreciation over years of the assets. Accumulated, adding it together, accumulated. The addition of what? Depreciation over years of the asset. They will now use to less the cost to get our carrying amount. So now let's look at the end of the first year. At the end of the first year, 20% times 100,000, because our carrying amount at that is 100,000, because we don't have what is the first year. We don't have any accumulated depreciation. So we give us what? 20,000, which means the first year, the depreciation for first year is 20,000. That's 20,000. Okay, so this is what we are talking about. I'm highlighting it. You can see that's what I'm talking about, the 20,000. So you now move to year two. That's second year. Now, second year is 20% of, remember, I said carrying amount. Now, it will now be 20% times 100,000 minus 20,000. The 100,000 is the cost. The 20,000 is the depreciation, the initial depreciation of what? That will be recognized in year one. And that will give us a total value of what? Of 80,000. So 20% on 80,000 will now give us 16,000, which is the depreciation value for what? For year two. Then we move to third year. Third year now be 20% times the carrying amount as well. Now, this time around, they use carrying amount, the previous book, net book value, which is year two. With this figure, they use this figure 100,000 minus 80,000, which is the carrying amount, minus this 16,000 to give us the carrying amount for what? For the third year, times 20% to give us 12,800. That's one method. Another method also is that you can use 100,000. This 100,000 minus, so this is what I'm talking about. This or, let's say or. So that means or, yeah. We're talking about this to be what? It will now be 20% times open the bracket. So now let's bring the 100,000 in. If we bring the 100,000 in, that's the cost minus accumulated depreciation. Now, what is accumulated depreciation? It means that all the depreciation that we have recognized over the useful life, and we have that to be what? Year one is 20,000. Year two is what? Is 20,000. So we have 20,000. That's year one plus year two is what? 16,000. After we have that, close bracket. Now, if you do this one, in what you are having here, will not be what? Equal 20% times 100. That's 20 plus 60. Now let's pick our calculator. Let's do that. That's 20 plus 16. We give us 36,000. So it now be what? 36,000. Now 100 minus 36,000. We give us 64,000, which means our carrying amount here will be what? 64,000. Now, if we do 20% of that, 20% of 64,000 will give us what? That's 64,000 times 20%. That's 0.2 times 64,000. That give us 12,800. The same what? I will see the same result that we have here. So we have here to do what? 12,800 using what? Using the carrying amount of second year minusing the what? The 16 of the what? The previous year to get our what? To get the carrying multiply by this to get the depreciation. But for this another method. Use the total cost minus the total accumulated depreciation, which is 20,000 plus 16,000. To now give us 64,000. 20% of 64,000 is 12,800. This is the what? Depreciation that will be charged to the profit or loss account for the year. Please, if you have any question, you can write down on what? On a comment. When I'm done, I'm going to look at the chat room to answer all your questions. Please, like I said, you must know this topic. This standard is what is very, very important. If you know this standard, you can have it at the back of your mind that you have 20%, 20 marks in your exam already. It's very, very, very important for you to know. So now, another method that we have is what? Revaluation method. They can also ask you this question in your objective. So please, you need to know them. They can ask you your objective as well. They can just give you a short scenario that you should calculate the depreciation for the third year. And this is what you expect to do. Now, revaluation method. Revaluation method, under this method, the value of the asset at the beginning of the year is added to the cost of what? Of the asset purchased during the year. So it means that what? At the beginning of the year, if I have an asset that worth 20,000, but during the year I purchase an asset of 5,000, it means that my total asset is what? 25,000. Then after that also, then I say, I will need to remove revaluation. So I have the beginning of the year, this is the value. But during the year, I purchased the value, I've added them together. Now, what is now compare that figure to the value of what I have at the end of the year. The difference there will now be my depreciation. Because if I purchase a vehicle, maybe at the beginning of the year, I have a vehicle that worth 1 million. Okay, fine, that's 1 million. I purchase another vehicle that worth, let's say, 500,000. That's 1.5. But at the end of the year, the value of my asset, that is 1 million, have dropped because of technological change or change in customer taste. So it's no longer worth 1 million, it's worth 800,000. So I now look at, okay, what is the value at the end of the year? The average of it is now 800,000. The one I purchased during the year also have dropped. Let's say it has dropped to, let's say it has dropped to 400,000. So that will now be 800,000 plus 400,000. That give me that's 1.2. So 1.2 against 1.5. What we gather what? Depreciation under the revaluation method. So let's look at the example. Ade has a van worth 20,000 at the beginning of the year. That's 2014. During the course of the year, he purchased additional van costing what? 10,000 naira. So which means the total cost for the van that he have is what? Is 30,000. That's 20 plus 10,000, 5,000. Ade values the total worth of the van at the end of the year to be what? To be 25,000. So the total cost is actually what? 30,000. That's why we added this year 20,000 plus 10,000. 20,000 plus 10,000 here. So we have 30,000. Now that 30,000 naira is what? Is the total cost. But now they now value it at the end. The value at the end now is what? 25,000. So it means that 30,000 and 25,000 give us what? 5,000 difference. And that 5,000 is regarded as what? Depreciation for the year. That's what for a evaluation method for depreciation. Okay. Now that we are done with I sent the material to you and I believe you have the material already. So the material have the solution already. Are you with me? The material have the solution already. So, but because of the accounting purpose, I just want us to solve it one after the other so that we can understand better. Okay. And let's go on. So, accounting treatment for depreciation. So, how do we account the treatment for depreciation? We have two methods of doing that. We have two ways of doing that. The first one is actually what we call we have the asset account and the depreciation account. So whenever we have the asset account and depreciation account, it means that the value of the depreciation will be used to reduce the asset over time. That's the first method. The second method, it will not be reduced. The second method will now create room for what we call accumulated depreciation accounts. Instead of the second leg to go to the asset account, it will be posted to the accumulated depreciation account. Then later on, under our financial position, it will be used to reduce the amount. Okay, let's go into figures so that we can understand that. So we have the asset account can be created with the S and the depreciable amount debited. Okay, so e.g., using example one. Now, this example one that we are talking about is this example here. Where is it? Yeah, this example here. That is the cost of assets. This is example one. Please, you need to be with me here. This example one. So on example one, we have calculated that what? That the cost of the asset is 100,000 and the depreciation is what? Is 18,000. So now we want to show it in our record because what we have done is mathematics. But now we need to what? Account for it, put in our books of account. So we come down, we open two accounts. Two accounts are affected there. We open the machine account. Machine account is the asset account. Depreciation account. That is two account that affected there. So after we have opened that, they will now come. The first thing is for us to know cost. We have to recognize the cost. Like I said, this is what? This is an account. And it's an asset account. And whenever an asset, it increases. So we put cost here on the debit side. We put cost on the debit side. And this is what is amount to be 100,000. We put 100,000 here. The second leg, it will be what? It will be on our bank or our payables. So we are not worried about that. That's the second leg, we want our bank and our payables. So after we have this, then we now want to depreciate it. And we want to depreciate it. The first method is going to affect. So we come to the other side. We come to the other side. And we do what? Now put depreciation. We put depreciation. Because of our time, I will shorten it, please. So we have depreciation. So after we have that, we have depreciation. Okay. I'm trying to look at something here, please. Okay. Now, the amount that we have calculated that depreciate, which means it have reduced the account that we have enjoyed from it. Is what is 18,000 based on what from our calculation example one, 18,000. Available for you to use the laptop so that you can use your phone to check. You have your phone with you, your phone will serve as the question, while the laptop will serve as what the solution for easy maneuver. Are you with me? Okay. Now after that, the next thing for us now to what? To now do the depreciation is what? Is 18,000. So we have 18,000. We have that to be 18,000. Next one that we have is what? We now come to this one. Now we have it on the credit side here. So we now come to the what? That's credit side. We now come to the debit side. Depreciation is a what? Is an expense account. So you come there and put machinery. You put machinery. You put machinery here. You put machinery here. Machinery to what? And that cost you. That machinery cost you put 18,000. Cost you 18,000. So you put 18,000. Then you have entered what? We have entered it. You are done with that. So the next thing for you is now what? To now close your account. So how do you close your account? Then you now come down what? Okay, this should be okay. So you close your account. Then you close the depreciation account to P&L, your profit or loss account. Your profit or loss account. Okay. You close it to your profit or loss account. Now if you close it, that will be now what? 18,000. 18,000. So we have 8,000. Then come here. Now this one, now to close this one, we don't have be what? Balance carried out. Balance carried down. carry down. When you have your balance carried down, what is the difference there? You now look at the debit side. The credit side is what? Is 100,000. What is the credit side? The credit side is 18,000. So 100,000 minus 18,000 will give us 82,000. That 82,000 naira is the balance that was at the end of the period. So we have 82,000. 82,000 now. So the addition of this reward give us 100,000. So we have balanced that. So we come back here and put what 100,000, 100,000. So we have closed that account. Once I close the account, then the one I explained earlier during last class is that what you now have what we call the what the under here. You have what we call the, let me say this. Now our balance brought down. You have your balance brought down. After you have a balance brought down, the balance brought down will now be the what the carrying the balance of the carrying amount, which is what 82,000, which is 82,000, 82,000. That's where you what that's where you do it, which is 82,000. Then you are done with the account. That's using the what? Using the first method. Using the first method. Okay. So after, then the next thing for you is what? The one that comprises of the accumulated depreciation and the one that was accumulated depreciation and depreciation account and asset account. So we have that to be, firstly, we have, okay, so let's go to the second method. Yes, to do second method. So let's go there. We have that to go. So these are the three accounts we deal with. We're using the same example now, but these are the accounts that we're dealing with. We have the machinery account, we have the accumulated depreciation account, and we have the depreciation account. Now for that, what we're going to do is we're going to come to the asset account, and the asset account is going to be cost. So we have cost here, and the cost is what is 100,000, isn't it? So we have the cost to be what to be 100,000. So we come back here, put 100,000 here. 100,000. After that, the second leg is going to go to bank or payable, or other payable. So the other one also you have is what we call the then we know move to our depreciation. Now under our depreciation, we go to what depreciation account. And under depreciation account, the account that we the second account, that second leg we go to is the accumulated depreciation account. So we're going to put here accumulated depreciation of how much? 18,000. 18,000. 18,000. That's what we have it to be 18,000. So we have it here, 18,000. After 18,000, the second leg is going to go with where? To our accumulated depreciation. And this one will call depreciation. And that will give us a total sum of what? Let me see. That's 18,000. Can you see it here? We have, I'm doing this for us to understand better. After we have that, the next thing now for us is this depreciation account is always written down or closed down to the profit or loss account or loss account. It always closed down to profit or loss account. It does not have balance breakdown. It always closed down to what? Profit or loss account. So we have that to what? To be 18,000. So close that to be what? To be 18,000. Then we come here. These accumulated depreciation accounts are what we call balance brought down, because an account that will be used over time. So we have what? We have the balance brought down here. Balance brought down. So we have the balance brought down here, and that balance brought down will be to balance the account. It will now be 18,000. It now be 18,000 to balance the account, 18,000. So we have closed the account for what? For the period. It means we have closed the account for the period. We have closed the account for the period. Now that we have that, now that we have closed the account for the period, we now need to what? We need to close the asset account as well. So how do we close the asset account as well? Come back here and we put what? Balance guidance. And after that, our balance guidance is 100,000. Our assets, we know what we know change. Our asset accounts will not change. So our asset account will not change. So after that, another one that we have is what we call another one that we have so our asset account will not change. In a minute, please. A minute, please. So after that, then the next thing for us to do is we close this up. Sorry about that, please. Sorry about the broken communication. So let's do this now. We close 1,000 to be 100,000. After I close it to be 100,000, then we have that. We have closed it up. So the next thing for us is to open back in the following year. So we put that this way. We open it back in the following year. We come here. We click here. So we now have balance brought down. We have balance brought down to be 100,000. It means that as we continue, 100,000 will be here. So we have that to be here, 100,000. So it means that the following month also, if there's addition, we to it. There is no addition, it will remain. Okay, sorry about the connection. Second day. So let me share my screen. So we can continue with class. Okay, let's continue with the class. Thank you. So the next thing that we now have is what we expect to do to prepare this. Okay, so let's see the way it's going to show on our statement of financial position. Let's see the way it's going to show. Statement of financial position is the same thing that we know our balance sheet earlier. So it's an extract. So please, just an extract. So what we have here is we're going to have what we call the non-current asset, the non-current asset. So we have the non-current asset here. So we have the non-current asset. After that, what we have on that current asset, we have the machine. So the cost will be bought down here. What is the cost? The cost is 100,000. That's the way it's going to appear if we use that. And look, you might not, you will not see it like this. What you see is gonna be on that position. So we have 100,000. So we have that to be 100,000. Okay, now that we have that to be 100,000, the other one is what? Accumulated depreciation. Accumulated depreciation now will be posted there. And the amount for accumulated depreciation is what? Is 18,000 for the period. So we have 18,000. So after we have the 18,000 here, so the next one that